Welcome, everyone, and thank you for joining us. Today, we're going to spend about half an hour talking about what's new in Social Security this year and what it may mean for you. My name is Marc Bautis. I'm a wealth manager and founder of Bautis Financial, and I'll be your instructor for today. So here are the topics we'll be touching on. Social Security paid a substantial cost of living adjustment this year. We'll talk about how the COLA is determined, put it into context, and see what it means for your Social Security benefits going forward. Another number affected by the cost of living adjustment is the earnings test threshold. We'll talk about how much you can earn in 2022 without having benefits withheld if you claim Social Security prior to your full retirement age. Next, we'll talk about taxes, both the Social Security payroll taxes and the income taxes that you may have to pay on your Social Security benefits. For those of you on Medicare, we'll go over the new Part B premiums for 2022 and see why it's not such a straightforward number anymore. We'll also cover some dates to watch in 2022. We'll give you an update on the status of the Social Security Trust Fund and discuss some ideas for reforming the system that makes it solvent for the future. And finally, we'll give you an update on some common Social Security claiming strategies. Okay, so first, we'll start off with the cost of living adjustment. In October every year, the Social Security Administration announces a bunch of numbers that are determined by the rate of inflation over the prior 12 months. The most eagerly awaited number is the cost of living adjustment, or the amount by which Social Security checks will be raised. Another number is the new earnings test threshold, and finally, the maximum amount of earnings on which Social Security taxes are assessed. So the cost of living adjustment for 2022 was 5.9%. That means that if your current benefit is $800 a month, you're going to get an extra $47.27 a month. The higher your benefit is, the higher your COLA is. So if your benefit is $3,900, which would happen if that's the maximum amount that you're able to collect if you and you're claiming at your benefit age of 70, you'll be getting a cost of living adjustment of over $230 a month. But here's the kicker. If you enrolled in Medicare and are having your Medicare premium taken out of your Social Security check, you won't see the full COLA. Part of your COLA, it may be absorbed by Medicare premiums. So we'll talk a little bit about Medicare premiums in a couple of minutes. To put this year's COLA in perspective, you can see here what the annual COLA has been since 1987. Until last year, inflation has been really low over the past few years, or even 10 years, you can say. Going back to 1987, the COLA has averaged about 2.6% a year. And the Social Security trustees project a 2.4% COLA going forward. But even if you've been paying attention to some of the CPI or consumer price index numbers that have been coming out, it looks like inflation may be here for a while. So you may even next year be seeing a similar rise in your Social Security cost of living and benefits to what you're seeing today. So here's a slide that shows how the COLA is calculated. It's based on the consumer price index for all wage earners. And that index, it measures the change in the baskets of goods and services that a typical worker might buy. So it covers things like food, transportation, housing, entertainment, healthcare, pretty much anything that you spend money on. In any case, the COLA, it's announced each year in October, and it takes effect with the Social Security checks that you begin receiving in January. But one thing that's a misconception is even if you haven't started collecting your Social Security benefits yet, so let's say you're delaying it to age 70 to get a higher amount, your benefit will be raised by the COLA. So when you do claim your benefit, you can be sure it will reflect each year's COLA up until the point where you take them. And if you're interested in learning how the COLA was calculated in detail, you can visit the website that's shown here. Okay, so that's the first big number change. Next, we'll discuss what the earnings test is. So the earnings test threshold, it's affected by the cost of living adjustment. As you probably know, if you're under the full retirement age and you work and receive Social Security benefits, part of your benefit may be withheld. And what Social Security does is they withhold $1 for every $2 that you earn over the threshold, which in 2022, the threshold went up to $19,560 a year compared to $18,960 last year. Now, if you're working and collecting Social Security benefits, but are earning less than $19,560, none of your benefits will be withheld. But I would like to obviously comment that trying to earn less money then what the threshold is, it's not exactly probably the best formula for building wealth. So if you're under the full retirement age and have the opportunity and ability to work, it's probably better to earn as much as you can and delay your application to start collecting your Social Security benefits. The new threshold for the year you turn full retirement age, it's $51,960, which is up from $50,528 last year. So this higher threshold, it comes into play if you're receiving Social Security the last year and you turn full retirement age in 2022. In the months leading up to your full retirement age month, $1 in benefits will be withheld for every $3 that you earn over $51,960. Once you turn your full retirement age, no benefits will be withheld, no matter how much money that you earn per year. While we're on the topic of earnings test, I want to take a moment to explain the monthly earnings test. So this comes into play the first year that you apply for Social Security benefits. So let's say you're under the full retirement age, you file for Social Security this year and continue to work. If you earn more than $1,630 in any month, your benefit will be withheld. Then next year, you'll be subject to the regular annual earnings test, which is that $19,560, which again will be adjusted for next year's cost of living adjustment. So again, generally the recommendation is wait until you stop working to apply for Social Security so you don't have to deal with the earnings test, but there may be exceptions, and we can certainly discuss your individual circumstance and whether it makes sense to collect, still work, and if you're under the full retirement age. Okay, so having said all that about cost of living adjustments, earnings test, let's take a moment and talk about payroll taxes. So the maximum earnings subject to Social Security tax went up to $147,000 from $142,800 last year. So what this means is that higher earners will pay Social Security taxes on more of their income. But remember, Social Security taxes it's a pretty good investment in the form of it's inflation. We're seeing the inflation adjusted income that lasts for life. So the more earnings you have, the more Social Security taxes you'll pay, the higher your benefit will be. Remember, as long as you're working and paying into Social Security, your benefit will continue to be adjusted. If you improve your earnings record, your benefit may even go up, even if you've already started collecting. So if you're interested in seeing how the Social Security Administration calculates the earnings cap, you can go to this website that's on the page here. The Social Security tax rate, it did not change in 2022. So as an employee, you still pay 6.2% of your payroll taxes on your earnings. Your employer will pay that same amount. If you are self-employed, you pay both parts for a total of 12.4% of your income. Also, the Medicare tax did not change. The employee's portion is 1.45% on all earnings. And then again, self-employed people pay both sides of that for a total of 2.9%. So here's the math. If you earn the maximum of $147,000 in 2022, you will pay $9,114 in Social Security taxes. If you're self-employed, you'll pay both the employees and the employer's share of the tax, which is $18,228. That Medicare tax that we talked about, it's on top of this Social Security tax. All right, so that's how your income or your payroll taxes are changed for this year. Now we're going to talk a little bit about how Social Security benefits are actually taxed, which is a little bit different. Ever since 1984, Social Security benefits, they've been subject to some level of taxation depending on your other income. So in here what we're looking at, this is a table that shows the taxation of Social Security benefits based on various income levels. And income in this case, it really means provisional income, which includes your adjusted gross income plus 1/2 of the Social Security benefits plus any tax-exempt interest that you receive, like maybe municipal bonds interest as an example. And if that provisional income is under $32,000 for a married couple, none of your Social Security benefits are subject to tax. If your provisional income is between $32,000 and $44,000, up to 50% of the married couple Social Security benefits are subject to tax. And if the provisional income is over $44,000, up to 85% of the benefits are subject to tax. Now, that obviously does not mean you're going to be taxed at an 85% rate. It just means you are going to owe tax on 85% of your Social Security benefits at whatever tax bracket you are in. And the thresholds for single individuals are 25,000 and 34,000. Now, you want to note that these income thresholds were never adjusted for inflation. So more and more people are having to pay income taxes on their Social Security benefits. And this is called, you hear a lot of times the politicians say, well, we're not raising taxes on anyone above a certain income. This is an example of these stealth taxes where what they do is they don't raise the amount or the threshold before tax is assessed. So what happens is more and more people just fall into, so they can say that they're not raising taxes, but what happens is a lot more and more people fall into this bucket that where they're going to get their taxes, where they're going to assess taxes on their Social Security benefits. There was recent law change with regard to RMDs, or required minimum distributions. The minimum age was raised to 72 from 70 and a half. So if you turned 70 and a half after December 31st, 2019, your RMD actually starts at age 72, not 70 and a half. And what they've done is that there's a new life expectancy table that takes effect this year that allows you to take a little bit less, or forces you to take a little bit less out of your IRAs or 401ks than the previous table. So if you need any help figuring out how much of an RMD you need to take, I'm happy to do that as well. And the thing about RMDs is that you may have had your income and tax situation all figured out. Then you have to start taking RMDs from your IRA, which can kind of blow up your plans. And these RMDs can bump you into a higher tax bracket. And in addition to paying the income tax on the RMDs, they also may make you or may force you to pay more tax on your Social Security benefits. So it's definitely something that you want to pay attention to and how they impact everything else that you have going on. It's a good idea to plan for Social Security taxes ahead of time. So for someone that's well in advance of their 72nd birthday, you may want to start drawing down the assets so that your RMDs don't force you into a higher tax bracket. The operative here is might. Beating the Social Security tax might be worth it, depending upon other tax considerations. So you definitely want to have someone look at kind of the whole picture and what the impact is of withdrawing earlier from your IRAs. You may also want to convert to a Roth IRA. So what this does is you're paying the tax now, but it generates tax-free income in the future. So again, talk to someone to see how that, what impact that will have on you. The other way to pay less in Social Security tax is delay claiming it. You reduce the number of years your income is subject to the tax. It's not the main reason to delay benefits. Mainly the main reason that people will delay collecting Social Security is because of the higher benefit that you get by delaying. It's about 8% increase in Social Security benefits each year that you delay taking them. But it obviously also helps with the tax situation as well. Okay, so this is no longer new news about the Secure Act, but it's important enough to really rehash it or remind everyone about it. So this legislation was passed in the end of 2019. It was called the Secure Act. It was a sweeping legislation, had a lot of provisions, but the ones most likely to affect everyone who's concerned about Social Security is the RMDs that we discussed, that they can be taken now at 72 and 70 and a half. Number two, if you're over 70 and a half and you have earned income, you can now actually still contribute to an IRA. It used to be that you couldn't contribute to an IRA no matter what after age 70 and a half, but now that people are living and working longer, IRA contributions are allowed after that age. So it opens up some interesting strategies that we can talk about privately if you're interested. And then number three, inherited IRAs must now be drained by the end of the 10th year. It used to be that IRA beneficiaries could stretch RMDs over their lifetimes in order to keep deferring the taxes. But the government says no more. They want to collect their tax on IRA distributions. This is the only exception to this. Is there's a couple exceptions. The main one is in the case of a spouse. But again, IRA beneficiaries must take and pay taxes on the entire IRA that they inherit by the end of their 10th year. So again, if you have questions on how this works, I'm happy to discuss that with you as well. All right, so let's move on to Medicare premiums. The base Part B premium, it's now $170.10 per month. So this is up from $148.50 last year. One reason for the big jump in Medicare premiums is the new Alzheimer's drug, Aduhelm. This drug falls under Part B, and its original cost was going to be $56,000 a year. When CMS was setting the premiums, the Medicare premiums for 2022, it felt the need to set aside reserves for this drug, which happens to be very expensive, and the reserves were actually built into the premium that everyone pays. Since then, the drug makers lowered the cost, and CMS is backing off from covering it for everyone. So for these reasons, there's been a call to lower the Part B premium from the $170, but no decision has been made yet. So you really want to keep your eye on any news on your premium that may come out that may say, hopefully, that the premium is going to be lowered. But even if the base premium is lowered, some people will pay more due to something that's called the Income Related Monthly Adjustment Amount, or IRMA, which I'll talk about that in a minute. If you're on Social Security and you have your Medicare Part B premium deducted from your Social Security benefit, there's a hold harmless provision that keeps your check from going down if the Social Security cost of living adjustment doesn't cover the rise in the Part B premium. So for example, in 2017, the premium jumped from $121.80 to $134, which was a 10% increase. But the Social Security cost of living adjustment was only 0.3%. So the few dollars that people got for their COLA adjustment, it didn't cover the premium increase. So their premium was actually left at $121.80 plus whatever the cost of living adjustment was. Some people's premium was even lower than that because they've been in this held harmless state in prior years. This year, Social Security COLA was 5.9%, while the Part B premium went up $21.60. That means that for almost everyone, the COLA more than covered the increase in premiums. So this hold harmless premium provision doesn't apply for this year, or for 2022. Now back to this IRMA. The issue that we're seeing is infecting more people is this income related monthly adjustment amount. And what it is, it's an extra premium you must pay if your modified adjusted gross income exceeds a certain threshold. In 2022, the first threshold is $91,000 if you're single or married filing separately, which is up from $88,000 last year. For married couples, the first threshold is $182,000, which is up from $176,000 last year. So your premium every year, it's based on the tax return you filed 2 years prior. So if you're on Medicare, your 2022 premium is based on the income you reported in 2020. But if your income is changed due to specific life-changing events such as retirement, you can appeal. And so in other words, if you reported high income in 2020 and you've since retired, you can appeal that higher premium. But one thing to note is that a one-time capital gains that you may have had from selling an asset, it's not grounds for an appeal. So in other words, if your 2020 tax return shows high income because you sold an asset that year, you'll have to pay the higher premium in 2022. But if your income went back down in 2021, your 2023 premium will be lower. So here's a table that shows Part B and Part D premiums for different income levels. If you're single and your income is under $91,000, or if you're married and your income is under $182,000, you'll pay the regular Part B premium of $170.10 per month. There's no income related adjustment. If your income falls into one of these other tiers, you'll pay an income related adjustment on top of that base premium. So for example, if you're in the second tier, you'll pay an extra $68 for Part B and $12.40 for Part D on top of your regular premiums. So keep in mind, these are per person. So if you're a couple, you can actually double these amounts. So you can see why you want to stay below this IRMA if possible. And also keep in mind that these premiums are just Part B and Part D that we're looking at. They don't include Medicare supplemental plans, any drug plans that you have, Medicare Advantage plans. It's only for Medicare. Okay, whether you're already on Medicare or getting ready to start, there's some dates that you need to pay attention to. The Medicare Advantage disenrollment period is from January 1st to March 31st. So during this time, you can get out of a Medicare Advantage plan and go back to the original Medicare. But make sure that you can get supplemental coverage. If you're going back to original Medicare, you'll want to get the gaps covered with a Medigap policy. But unless you're applying during your Medigap open enrollment period, which is generally the first 6 months after enrolling in Part B, they don't actually have to take you. If you have health issues or if you drop your Medicare Advantage plan, you may not be able to get a Medigap policy. So be sure that you line that part of it up first before you think about dropping any Medicare Advantage plans. January 1st through the March 31st, it's also the Medicare general enrollment period. This is for people who've never signed up for Medicare when they turned 65 or when they left their employer plan. If you do sign up for Medicare during this time period, your coverage actually doesn't start until July 1st. The annual open enrollment period for people on Medicare is October 15th to December 7th. In September, you'll receive information from your current plan about their offerings for next year. You definitely want to pay attention to this because your premiums they might be going up, your coverage might change, or there might be new plans in your area. If you currently have a Medicare Advantage plan, you want to see how it will change for next year. Or if you have the original Medicare, you want to see how your drug plan may change for next year. They're always making changes to what drugs are covered, what are not covered. Then you want to look you want to do a comparison. You want to look at other plans offered in the area, see if there might be another one that is better for you. So if you do come up and say, do the analysis and see that there is one that's better, you want to contact the new plan by December 7th. If you don't do anything, you'll be re-enrolled in your current plan for another year. Although you have a chance to switch your Medicare Advantage plans during the disenrollment period that we just talked about, it's much more efficient to make your choice during this annual open enrollment period and stay in your new plan for the full calendar year. Okay, one of the questions I get a lot is, what about the future of Social Security? And they'll say, will it still be there for me? It was designed as a pay-as-you-go system. So payroll taxes from current workers go into a trust fund that's immediately paid out to current retirees. And because baby boomers have been in their peak retirement or peak earning years, the trust fund has actually accumulated more than it's needed for current benefits. So right now, the trust fund has about $2.9 trillion in it, which it's invested in these special issue treasury securities. Now, as baby boomers start retiring, these trust fund assets will gradually be drawn down. Over the next 75 years, cost will begin to exceed income. There are enough reserves in the system to be able to pay 100% of the promised benefits until 2034. After that, if nothing is done to reform the Social Security system, income will be sufficient to just cover 78% of the promised benefits. So although the system is not in imminent danger, most people agree or say that the earlier that reforms are instituted, the less painful they'll be on everyone. And it really is just a math problem that involves an increase in revenue, a cut in benefits, or a combination of the two. So here are a few ideas that have been proposed, and they've kind of been proposed for a while now. But one is to increase the maximum earnings subject to Social Security tax. Currently, that's what we talked about at the beginning of this webinar, where it's right in 2022, it's at $147,000 of earnings are subject to that 6.2% tax paid by you and the employer. One way to shore up the system is raise the earnings cap or eliminate it altogether. So if you earn $200,000 per year, only the 147 is what's taxed. What this proposal is saying is that tax the full 200,000 or tax some number that's higher than $147,000. Another reform proposal calls for raising the full retirement age. Currently, full retirement age is 66 for people that are born between 1943 and 1954, and 67 for anyone that's born after 1960. So an argument in favor of raising the retirement age is that people are living longer. An argument against it is that people's occupations involve, physically or hard labor, they really can't work, until age 70. They have to retire before that. Still, another reform proposal that would change the benefit formula so that increases happen at a slower pace. This would affect benefits of all future retirees. And then the last one is some people are talking about changing the formula for cost of living adjustments. This could give retirees a smaller benefit increases going forward. But as anyone that's going through, the inflation and having to spend more money for now, having these cost of living adjustments actually helps, get past some of the higher costs for any goods or services that they're buying. So, given that there are a lot of ways that Social Security can be reformed, is Congress likely to address the issue this year? Some are saying that, well, Democrats have a majority in the House, and with the Democrat Democratic vice president casting the tie-breaking vote in the Senate, they may get around to acting on a previous proposal that was introduced by Representative John Larson. So this proposal would make several changes to the system, both raising benefits and raising taxes. Benefits for current retirees wouldn't be affected except that the cost of living adjustment would be based on a new index that measures inflation for the elderly. So that takes into account things retirees typically spend money on, like healthcare. So it would presumably be an improvement. If passed, the proposal calculates that it would restore full solvency to the system over the next 75 years. But what most people think, and I guess I'm falling into this bucket, is Congress will probably not address Social Security this year. If you listen to the headlines, there's a lot of other issues that are taking priority. And because there is $2.9 trillion in the trust fund, benefits are not in immediate danger. The last time that Congress made any major changes to the Social Security system was in 1983. And in that time, the trust fund was within a few months of running out of money. So theoretically, Congress has until 2034 before they have to worry about this actually happening. All right, so to finish up, I'd like to talk a little about Social Security claiming strategies. Even though these may not affect all of you, especially for the people that have started taking Social Security, there are some changes and some interesting topics to go over. So some of you may have heard about a claiming strategy called file and suspend. And this is the one where the high earning spouse files for their benefit, immediately suspends their benefit. And because he's opened up his record, the lower spouse or the lower earning spouse can claim a spousal benefit, which is half of the primary spouse's benefit. However, the Budget Act that was passed in November of 2015, it disallowed certain spousal claiming strategies. File and suspend was one of them that was disallowed. So the last day to file and suspend was actually April 29th of 2016. Unless you placed your suspension before that date, your spouse will not be able to claim a spousal benefit this way. So for those of you who did suspend before the deadline, and it's really the only reason I'm bringing it up, it's mostly a question of making sure your spouse takes their spousal benefit at the optimal time if they haven't already. Other than that, it's basically just a question of sitting back and waiting because your benefit will automatically resume at age 70. The other strategy, claim now, claim more later, it's more important. If you were born before January 2nd, 1954, you're grandfathered into this key strategy, which could potentially shore up your retirement. Remember, it's generally possible to take a benefit based on your spouse's record if your own benefit is higher. But for those of you that were born before January 2nd of 1954, you can do this, provided you wait until your full retirement age and directly specify on your application that you want your spousal benefit only. Now, why would you do this? If you restrict your application to your spousal benefit only, you can receive a spousal benefit while your own benefit builds delayed credits. So let's actually look at an example of this. So here we have John and Jane are both 66. John's primary Social Security insurance amount, or his PIA, is $2,400. Jane's PIA is $1,600. So here's what they can do to increase their Social Security benefits. Jane files for her benefit now, starts receiving $1,600 a month. John files on Jane's record and receives half of her benefit, or $800 a month, while his own benefit builds delayed credits. Now, when John turns 70, his benefit will have increased to $3,168, thanks to that 4 years of that 8% annual delayed credit. So he gets half of Jane's benefit for 4 years and then switches to his own maximum benefit. And then the other benefit is if John dies, the higher benefit will transfer over to Jane. So this is basically the best case scenario for this couple, but there's no guarantee. It obviously depends on what each spouse's benefit is, whether this will actually work or be able to maximize benefits for you. And then it also depends on your respective age. So if you'd like, I'm happy to run the calculation that will look at your, both spouses' benefits and ages and look at some different claiming strategies and see which one is the best option for you. All right, so that takes care of what's new in Social Security. I'd like to offer you a free Social Security checkup, which is just what I've talked about. I've seen a lot of people that miss out on benefits because they didn't really know that they could claim them. And we'll go over a couple examples here. This one's not terribly uncommon. It's a married person who never added on her spousal benefit after her husband filed. So for example, in doing a Social Security checkup, we would look to see if the lower earning spouse benefit is significantly lower than 50% of the higher earning spouse's benefit. And if this is the case, it suggests that the lower earning spouse filed first, claimed her own small benefit, then sometimes later her husband files for his benefit. And this would entitle her to a spousal benefit, which would be added to her own small benefit. But she would have to apply for the spousal benefit, which she didn't know that she had to do. So Social Security checkup reveals some things like this. Another one is a divorced person who didn't know that she could claim a spousal benefit off of her ex-spouse. Now, not everyone could do this. It's being phased out by the Budget Act, but some people can still do it. And some people have more than one ex-spouse, and they may be claiming off of the wrong ex-spouse. So one thing the checkup does is it can help divorced people find out if they're receiving all the benefits that they're entitled to. Another one is where a divorced person's ex-spouse died. Sometimes ex-spouses don't always keep track of each other, but if a person was married over 10 years to an ex-spouse who has died, they may be able to get a survivor benefit based on that ex-spouse's earnings record, which if it's higher than their own record, higher than their own benefit, may make sense to do. So it's definitely, checkups can definitely identify some of these things. So if you know anyone, or if you would want a Social Security checkup, we may be able to help you identify some possible benefits that you may not be thinking about, explore some claiming strategies, and then also see how Social Security fits into the rest of your retirement income plan. So it concludes our Social Security presentation. You can, like I said, you can schedule that free checkup or call by going to our website, which is bautisfinancial.com/call. Thank you for attending. We also have a learning center, which is bautisfinancial.com/learning center on our website, where we have recordings of all of our previous webinars that we've hosted this year and last year as well. So you can see any of those. And like I said, we're happy to do a free checkup and just see if there's anything that you're missing out on how you can improve your Social Security situation.